Hello and welcome to the podcast hosted by myself, Louis Kessinger, and my dad, Tommy. We are a part of the Kessinger Lee Group at Baird and have been serving investors in our area for 4 generations. Our goal is to start a conversation around topics within the world of finance and to educate you, our listeners. All right. Well, here we are. We're
Q4.
Yeah, we're 23 days late, but we're here.
Well, we're going to give a thorough evaluation.
Yes, we had so much research to do. We were looking at all the numbers, and we wanted to make sure that you got to see all of them.
Is that right?
Yeah, so that's why we're here now instead of earlier, or as some would call it, on time. But, you know, we had a lot of stuff that happened in the third quarter of 2024. It has been an action-packed year, and this quarter had a lot of action in it as well. And that was kicked off by the Federal Reserve finally cutting rates.
Right. So we've entered into a new Federal Reserve cycle, and this is the cutting rates cycle.
Yeah.
Now, I would tell everybody to reserve caution and don't get too excited, because I believe this will be very gradual.
Yeah.
So the first cut was the middle of September, 50 basis points by the Federal Reserve, taking us basically from a Fed funds rate of 5.25 target to 4.75 target. That will have the net effect of pulling 30 to 90-day T-bills down into that range over the next several months. There's a pause, no meeting in October, and then the next meeting is after the election, November and December. It is widely expected that they will taper those cuts down to either 0 or 25 basis points.
Yeah, and so a few things to touch on with the rate cuts. So we've seen the un-inversion of the yield curve.
Great point.
It was inverted for, I think, the longest time on record. And the reason that's important is so that is when short-term rates are higher than long-term rates. And the reason that's important is because it's often looked at as an indicator of recession.
And interestingly enough, the only time in the last 100 years that an inverted yield curve did not signal a recession was 1968. And something similar was going on. So we were in the middle of the Vietnam War, and the government was spending an absolute fortune on military spending and all the parts that go along with that. So you had a massive influx of government dollars into the system in 1968. So the inverted yield curve did not start or signal the start of a recession.
Yeah.
And here we are, middle of COVID, post-COVID, inverted yield curve, massive physical dollars coming into the system through federal government spending, and the same outcome.
Yeah.
No recession, or a mild earnings recession in 2022, but certainly not an economic recession in the traditional sense.
Yeah. And then I'll touch on one other thing on rates coming down. And that is that when the Fed cuts rates, the rates that are most affected the quickest are short-term rates.
Correct.
So that's why you've seen the inversion or un-inversion of the yield curve. But then
re-inversion? No.
But then I'll touch on the fact, hey, rates are coming down. Should I refinance?
Right.
Should I refinance my car? Should I refinance my home? So we're not giving advice right here. So talk to
especially on interest rates.
Talk to your CPA or your trusted advisor on that. But auto loans and home loans are a lot of times tied to the 10-year.
Or commonly the prime rate.
The prime,
So the prime lending rate, and you typically have something. So the prime was at 5.5, It's down to 5. A lot of banks key off of, they'll add 3 points to that. So your home equity line might have been 8.5.
Yeah.
Now it's 8. To your point on the 10-year mortgage rates, we got below 7 for a hot minute. And so that was an opportunity for people. And we saw mortgage applications increase.
Skyrocket.
All of that has the intended goal of the Federal Reserve to create economic activity.
Yeah.
And that in turn was good for the third quarter, in particular for equities.
Yeah.
Currently, the S&P 500 is up 22.1% through the end of September. And we've also had very strong earnings over that period. The second quarter earnings were up 11%, 2024 over 2023. We are now into earnings reporting season as we are talking right now, and companies are starting to report how they've done year over year in the third quarter, and so we're excited to see how all that transpires.
Yeah, absolutely. And I think in terms, we shouldn't just kind of skip over the fact that, hey, these earnings have backed this up for now a year and a half. I mean, it's not just speculation flying in saying, oh man, it's gone up. I think it'll go up more because it went up before. and it's, man, these companies are bringing in cash flow, and it is not just large cap growth. Large cap growth has led the way. But small caps up 9.3%, mid caps up 9.2%, and both of those outperformed large cap, which was up 5.9% in the third quarter.
Yeah, I think that's a great point, and that's exactly what we wanted to see. I mean, if you go back to our earlier episodes after the first quarter, we were talking about the Mag 7 and these 7 largest companies in the S&P sort of pulling the other 493 with them. Well, that's starting to reverse itself a little bit, in that the other 493 are starting to pull their own weight.
Pick up the slack
and that should be good for your portfolio.
Yeah, absolutely. Absolutely. And, just in terms of all of the sectors, so if you look at every sector in the S&P 500, 10 of the 11 small cap sectors, not the S&P 500, small caps. So you're looking at that broadening out of the market. You're looking at small caps. 10 of 11 small cap sectors finished higher in the third quarter. I mean, it's hard to see everything win and just about everything won in the small cap space.
Yeah, and I think that's a healthy thing. Mm-hmm. Again, smaller companies rely on borrowing from banks. To fund their business. Mm-hmm. And if the pressure of those rates is coming off, then I think that's a net positive for some of those smaller businesses to succeed in this space. But you're right. I mean, it's been a bit of an all play this year, with so far year to date. All sectors of the S&P 500 are positive. Last year, just as a reminder, in 2023, we had 3 sectors that were negative. You know, so you had consumer staples, energy, and utilities were all negative in 2023, and this year, all sectors are positive for the moment.
For the moment. All right. So now I'm gonna throw a question at you, and I'm gonna take you back to 2017 and 2018. The market's ripping. Yeah. Everything's great. And December of 2018 rolls around, and the market gives back all its gains.
Well, so that was, again, the good news here is, with the Fed cutting rates in September, we're starting a cutting rate cycle. Yeah. In December of 2018, we were starting a rate increase cycle. And it turns out that the Federal Reserve found religion and put a pause on that in early 2019. But yes, the S&P was down almost 20% in December of 2018. Yeah. And we had been up about 21%. So
Yeah.
we ended the year flat, but it was a sure ugly way to do it. A lot of people call it the Christmas Eve massacre. It was
shooting Santa Claus out of the sky.
right.
And I do think another thing that's interesting about just that specific time period, and I just bring it up because it's recent and it was kind of 2 years of great performance,
Which is where we are now.
Erased by 1 month. And so that's where we are now. That's why I bring it up. I'm not saying it's the same. I just kind of wanted you to draw those comparisons and maybe tell us a little bit why it was different. But we had an event. Our
last
team.
week.
So we did an investor meeting for our clients, and we had Ross Mayfield
investment strategist from Louisville,
and so we had him come and talk about some things, and you talked about some things just regarding kind of the U.S. economy and population and the market as a whole, and he touched on just election year type things that people get worried about. You want to walk us through a little bit of what we kind of went over at that investor meeting, some high level takeaways?
Yeah, thanks. And we can actually send some of these out or what have you. But the bottom line is we were trying to make sure that clients understood the context of where we were in terms of the markets, the economy, and then we are less than 3 weeks out from the election. I mean, we're like 2 weeks out from the election at this point. And so things can get weird in the market around these election cycles, but all points in time are different. And so the big takeaway was we were looking at 50 years worth of data that we pulled from the federalreserve.gov as well as the census.gov.
Yeah.
And just looking at 50 years ago in 1970, the country had 203 million people. By 2020, 50 years later, the population of the United States had grown to 330 million people. And so it's hard to compare. We hear these things all the time. Oh, this market is just like the 1970s with all this inflation. Yes, but this is nothing like the 1970s.
Right.
The other thing we pointed out was the gross domestic product of the United States in 1970 was basically at $1 trillion.
Yeah.
And by 2022, so we don't have this year's numbers, but by 2022, that was up to $24 trillion.
Yeah. And
So-
just for kind of frame of reference, we were writing $1 trillion stimulus checks.
Right. The whole economy in that was half the bill.
Yeah,
It was a $1.9 trillion bill.
Here we are 50 years later, and you're writing checks, right, wrong, or indifferent. You're writing checks that are the size of the entire economy from 50 years ago.
Right. And so when you have shocks to the system in the 1970s, like the oil embargo, where the OPEC countries dramatically raised the price of oil, which related directly into the price of gas, that had a chilling effect on the markets, on the economy. Inflation shot up. There were a whole lot of ripple effects. You can't compare those. And just for reference for our listeners, in 1974, OPEC raised the price of a barrel of gas to $5 a barrel. We sit here today at about $65, $66 a barrel, and we're all excited that the price of gas has come down from $5 a gallon to $2.80.
Yeah, and it's and to your point, it's just so different in terms of how much oil the United States is producing.
Right.
So
and energy,
that
natural
helps,
gas.
because in the 70s we were kind of beholden to OPEC, and that drove us to a point where odd and even numbered license plates had to get gas on different days. And but today
Somebody's been reading history.
Yeah, but today we're sitting here, and it's not like the Middle East is the most peaceful place in the world.
No, it's a powder keg.
It's got some struggles still going on, and the price of oil is going down.
Right.
So it's so different. It's just so different.
Right. Each time period is very different, and that was sort of the message. And then the other message that we sort of were telling our clients at the event was just be cognizant of where and how you're getting your news, because they are doing a job, and part of that job is to tell everybody what's going on in the world, and the other part of that job, just to be quite frank, is to sell ads.
Yep.
And so to continue to get you to watch from segment to segment, and so you just need to be cognizant of it's. If it bleeds, it leads, is the old adage that Ross Mayfield said at our event, and he's exactly right. You're not going to turn in because a new set of puppies was born. It's going to be something that's not very much fun.
And unfortunately, he had numbers to back it up on, hey, the news actually has, like, we've studied the headlines.
Right.
And the words and the rhetoric that are being used are unfortunately just so much more negative than they used to be. And the other point that he made is not only is it more negative, but we have it all the time.
It's all the time.
It's in our pocket.
It's omnipresent. It's on your phone. It's on your iPad. It's on your computer. It's on your television. It literally is omnipresent. So I thought that was a great event. We looked for, that was our first one. We had done. We had a good crowd. Looks like we're going to need a bigger room. So next year we're already planning for what that would look like and what the topics will be, and we will have, regardless of who wins the election, we will have a new administration, and so there will be and a new Congress, a makeup of Congress. Again, regardless, not talking about blue or red, just talking about what we know is going to happen is there will be changes, and so there will always be plenty to talk about at those events. One other item that I is getting a lot of attention is the national debt. And we did have a brief discussion about that. And for our listeners, for people listening to this, I do think you're hearing about it all the time, and you're hearing about $34 trillion in the debt of the country, headed to $40 trillion soon. You are hearing about deficits, budget deficits that are ongoing, but what nobody ever talks about is actually the household wealth of the United States. And so if you think about our total debt, somewhere between $36 trillion, depending upon how you calculate some of that, but our household wealth, by virtue of the assets this country owns, that you and I own, our houses, our stock portfolios, the businesses that you run, the cars that you drive, that household wealth is now just shy of $160 trillion. And I think it's hard for all of us to get our heads around what a trillion means. So I changed this and just said, imagine the United States as if it was a house, and your house was worth $160,000, and you borrowed $35,000 against it. If I told you those numbers, that really doesn't sound that ominous. And if I told you that all you had to pay was the interest expense, you don't even have to make a principal payment on that loan yet. Eventually you will. Eventually, all bills come due. But the interest on that is a fraction of your income. And so everybody gets worked up about this, and the problem needs to be solved by people way smarter than me and Louie. But I did want to give context to the fact that while we talk about this national debt, we rarely, if ever, talk about the net worth of this great country. And $160 trillion is a ton of money.
Well, $160 trillion. So there's that. There's
by the way,
also
that's
like some B-2 bombers and some aircraft carriers
to protect us.
But and then so just another way to kind of help with wrapping our heads around what is that debt number? Like, how do I think about it? in 2023, the gross federal debt in the United States amounted to $93,500 per person.
Yeah.
So, right, wrong, or indifferent, that's a way to think about it, and to kind of hopefully ease your thoughts about it, because like my dad said, 160 trillion in assets are backing that up. So
yeah, so I just think everybody needs to keep things in perspective, and that's really what the night was about, was keeping things in perspective. And so it's been a great market in 2024. It was also a great market in 2023 in terms of a recovery. So we were coming off of a 2022 low. I mean, we're back to where we were and just above it in 2021.
Yep.
So it's important to just keep a long-term focus. And that was sort of the other piece of the puzzle the other night, was just emphasizing investing for the long term, making sure that you got your financial plan in order, making sure that you're ready for things that happened, the Decembers of 2018.
Yep.
They come out of the blue. March of 2020, I promise, in January of 2020, there were only a handful of people that even dreamed that the whole country would be shut down. And the market went down 30% over about 5 weeks. And so it was short-lived, but it doesn't mean it wasn't painful.
Right. And I mean, that's the definition of real risk is the risk that you can't see. And I mean, we can build portfolios to, have betas and different
alphas
correlations that cancel each other out. We can do all kinds of fancy tricks, but when the world shuts down, not much I can do except watch it go down with you.
Yeah, watch it go down and have a plan.
Yeah.
And
So
stick to the plan, because the plan takes into account those items that nobody was thinking of.
Yep.
And we were able in that time period, both 2018, 2020, to look at the plan and say, we prepared for this. This is why we did the plan. It doesn't feel good, but you're gonna be okay.
Yeah.
So as we're looking out into the fourth quarter, we'll have some things that will be known. The third quarter earnings are being reported as we speak.
Yep.
They will be completed by the end of November. We'll have an election. I feel super confident saying we will not know the outcome on Tuesday, November 5th, but sometime in early November, we will know what has transpired, what the makeup of Congress will be, who's in power in the White House.
Yep.
And we will have plans to be able to make as we go forward into 2025.
Yeah. And that just hits on, certainty. The market likes certainty.
And it never has it.
But those are some things that once they're kind of decided, then we can start guessing about other things.
Yeah.
Or the market can, not we.
Yeah.
But I do want to say, just kind of before we finish up, next time we do one of those events, I think we hope to have some microphones and record it, so that we can share it for anybody who can't make it. But if you're listening, thank you for those who did come. We hope you enjoyed it, and we hope you learned something. And thanks for listening to us again today.
Yeah. Have a great quarter. We'll be back next time on Ticker Talk.
Yep. See you in January.